Let's shift our focus to oil, which is perhaps at the center of this conflict. Brent crude jumped to around $80 a barrel as tensions escalate in the Gulf. Analysts now warn prices could move closer to $90 or even $100 in no time. The immediate concern is the Strait of Hormuz, which is a narrow waterway that handles roughly 20 million barrels per day, about 1/5 of global oil supply, along with a similar share of global LNG trade. Iran has warned vessels against transit, prompting tanker owners, oil majors, and trading houses to suspend shipments through the route. While previous flare-ups saw prices spike and then normalize quickly, early indications suggest this round of retaliation could be broader, raising the risk of prolonged disruption and a sustained geopolitical premium in oil markets. Country-wise, the dependence is stark. Saudi Arabia exports the bulk of its crude through Hormuz, although it can reroute up to 5 million barrels per day via its east-west pipeline to the Red Sea. Iraq, which is OPEC's second largest producer, exports most of its shipments through Hormuz. Kuwait, Qatar, and Bahrain have no alternative export routes and are fully reliant on this particular waterway, that is Hormuz. For importers, China is the single largest buyer of the Gulf crude, followed by India, Japan, and South Korea. Much of their Gulf oil flows through this narrow 21-mile wide corridor. Qatar, which is one of the world's largest LNG exporters, also depends entirely on Hormuz for its gas shipments. Even if the strait is not fully closed, disruption could remove between 8 to 10 million barrels per day from global supply. Iran itself produces roughly 3.4 million barrels per day, accounting for about 4% of global supply. The country exports between 1 and 2 million barrels per day and mostly to China. OPEC moved to raise output by over 200,000 barrels per day, which is higher than anticipated, but modest as compared to the global demand. Analysts say that the hike is unlikely to offset major disruption if Hormuz flows are significantly curtailed. An escalation with Iran also carries a clear economic risk for the U.S. Higher oil prices would quickly filter through to gasoline. U.S. pump prices have been climbing in the recent months. Higher oil could push prices back above $3 per gallon. Affordability remains a key political issue for Donald Trump. Remember, any sharp increase in fuel costs could add pressure on consumers and weigh on economic sentiment. While past conflicts saw oil prices spike and then normalize, this time retaliation appears much broader. If energy infrastructure or shipping lanes face prolonged disruption, the economic consequences could be more lasting and politically sensitive.